Okay, we're going to start on chapter 3. Talks about securities market. It's kind of a short chapter. It talks about securities market, difference between private lending and public companies, secondary and primary markets, those kinds of things. So, first of all, the primary market is new issue created or sold stocks or equities, generally speaking, where the issuer receives the proceeds from the sale. So this would be, we're going to talk about IPOs here in a second, but effectively when a company themselves sells it to the market. So if Apple issues new stock, if Microsoft issues new stock, if Target issues new stock, or when companies go public, which is the IPO that we'll talk about in a couple of pages, that money is received by the company themselves, not a secondary person or not a different individual. Whereas a secondary market, which is most of what you buy and sell on the open market, you're buying it from someone else. So when you go, if you go right now and go look to buy a share of stock in a publicly traded company, unless it is a company that's currently issuing new shares, most of the time that's going to be is you're buying it from another individual who already owns it, okay, and that's a secondary market. So you're buying it from another owner. So it's a transaction owner to owner, one person selling you their ownership. So the current owner sells to another party, the issuer does not receive any proceeds from the sale. So in my same example, if Apple issues new stock, if they increase the number of shares of stock outstanding, then they would receive the money from that sale. But if you just go out on the open market right now and buy a share of stock from someone else and they're not offering new shares, then that money goes to the owner, not to Apple themselves. Okay, so the secondary market versus the primary market. Privately held versus publicly held companies. Okay, privately held companies, ownership by a small group of investors, shareholders up to 2,000 shareholders in total. The financial statements have fewer obligations because they don't have to release as much information to the public, and they're sold directly to a small group of investors. A couple of the largest privately held organizations in the world reside, at least parts of them reside in Wichita. Of course, one was founded here, that's Koch Industries. They are, a Wichita-based company, and they are, depending on what financial aspect you want to look at, either the first or second largest privately held company. You cannot go buy a share of stock. Instead, you'd have to become a part of the membership group. You have to have less than 2,000 shareholders, and you kind of have to be invited in almost in order to do that. You can't just go purchase it. You can't go on an online format and just buy some. Cargill's another one. They have offices, I know, locally. They're not founded locally, but they do have offices around here. Cargill's another very large, arguably, again, number 1 or 2, depending on what metric you're looking at, largest privately held company in the world. Also has offices in Wichita and Kansas. Publicly traded companies, securities are sold to the general public, so anyone can buy them. And investors, the idea is that they trade shares. There's not a limit to the number of shareholders. If it's a publicly traded company, they can have as many shareholders as want to buy in. They are legally obligated to release financial statements to the public. They are also legally obligated to have audits done by an independent firm, to take it back to accounting a little bit. They have a lot more restrictions and legal obligations than what a privately held company does. Also, depending on what form or legal form of ownership they choose to have. If they're privately held, they can choose to have different ones. Publicly traded, as I understand it, although there are publicly traded partnerships, generally speaking, we're talking about C corporations. So there's tax implications as well to being a publicly traded company, as well as just more severely regulated overall, publicly traded versus privately traded. So then what's the benefit of being publicly traded? Well, this right here, unlimited number. They can issue shares and they can bring on as many owners as they want and have basically an unlimited amount of equity, potential equity, assuming the company's doing well, that they can bring in. So it allows for substantially more growth. Whereas when you're limited to 2,000 shareholders, only whatever money that those 2,000 people, 2,000 individuals or businesses or organizations can afford to put into the business is the limit to the equity that you can receive to expand and grow your business. Okay, publicly traded companies. Publicly traded companies, the IPO is the first sale of stock by a formerly private company. So IPOs happen, I wouldn't say extremely frequently, but they happen on a fairly regular basis. And it happens when a company moves from being a private organization to being a public organization. And it can go back the other way too. There's been several car companies over the last couple of decades. I want to say Dodge did that, and Chrysler might have too, which Dodge and Chrysler were part of the same company for a while, where they were private and they went public and then went back to private, and that can't happen. But the publicly traded companies, the IPO is the first time they're selling stock that's formerly a private company. The underwriters are the individuals that purchase security from the issuing company to resell them. And then the prospectus is the description of the firm and the security that's being issued. So prospectus is just, you know, who's offering this, what company are they? Underwriters are the ones that buy the securities in the first place, so it gives them that influx of cash, that primary market cash for that public company, that now public company. And then then we have the IPO. The IPO, the issuer and the underwriter put on a roadshow. Okay. And when they're talking about this, they want to make sure that they are backing up the price that they're asking for this. And a lot of times they're underpriced to begin with. So post-sale returns an average of 10% more. It's easier to market and usually less costly to the issuing firm. So generally speaking, you'll see IPOs be undervalued to begin with. It also makes it so that more people want to invest, and when more people want to invest when something's undervalued, which is when people do want to invest, that's when you see the stock price start to rise on that secondary market. So it's also kind of good press. That's what they mean by a roadshow. It's good press. It looks good for the company, that they are, you know, being more valued by investors than what they were showing their own value or what they believe themselves to be the value. But a lot of times that's fully intentional. All right, so we got the issuing firm. So this would be like the organization itself. This would be the company that is going public, the company themselves. We have the lead underwriters. Those are the ones that buy directly from the company that's offering it, who then sell to investment bankers. And those investment bankers then sell to private investors. This is the average initial returns for US and European. A is US and European markets, and B is non-European IPOs, the average return. So you see the United States falls right here. I don't have the exact number, but I would say that's probably 17%, 18%, something around there. That's the average first day returns for the IPO. So companies are really undervaluing themselves by that much, or at least I should say the market is valuing them higher than they're valuing themselves on that first day. And you can see this number is a lot larger. The highest one in European and US and European companies is you know, just over 50, which is Greece, which has had a lot of economic trouble in the recent past. Whereas you got all the way up to, in the city of Jordan, you got all the way up to 150% return. And you see that they, you know, even the lower ones are bordering on this 25%, whereas the first half of these are just over 10% for the European IPOs and the US IPOs. All right, SEC Rule 415. SEC Rule 415 is a security pre-registration. And effectively what it means is when you've registered in this way, you can offer the stock you can offer the stock anytime in the next 2 years. They should need to give 24 hours notice of all pre-registered amount that can be offered. This rule was done or was introduced in 1982. So why would a company do this? So that's what the question here at the bottom asks. Why would a firm use Rule 415? Well, there's a lot of different reasons. It's also called shelf registration, because effectively what you're doing is you're saying, okay, I have the right to sell these shares of stock anytime in the next 2 years. But if I want to make sure I'm getting the most bang for my buck, or the most money, equity, cash inflow that I get for selling the stock, then I might want to wait and hold off. So I would register, I would shelf that registration, and then in that 2-year time frame, I would wait until it's most advantageous for me to sell those, meaning when the market price has gone high enough that I believe that the firm is being correctly valued. And I'll continue with this in the next video.